Welcome to the Wealthologist Weekly, your go-to source for all things wealth management. I'm your host and the Wealthologist, Chris Hobart, and today I want to dive into a topic that's pretty crucial for anyone looking to boost your financial success while also keeping your risk reined in. I call this one Why Asset Allocation Drives Returns. See, we all dream of those higher returns on our investments, right? But we also don't want to take too much risk to get there. So how do we do it? Well, here's the thing. It's not just about picking the right stocks or bonds. It's something that we call asset allocation. So let's break this down into simple terms, make sure you understand it, and then we're going to dive a little bit deeper. So to understand asset allocation, it's kind of like spreading out your investment money in different baskets. And all of these baskets have different purposes and different risk levels. So these baskets are different types of investments like stocks and bonds and real estate and cash. Now, the idea is to balance the risk and reward. So how much money you put in each basket really depends on your goals, maybe the income you're looking to generate, how much risk that you can handle, and how long you're planning to invest. So why is this all important? Well, let's imagine that you put all of your money just in one basket and you're counting on that one basket to do well. But if that basket takes a hit, so does all of your money. But on the other side, if you spread your money in different baskets, the impact of one bad basket or one bad investment is a lot smaller. So now we're starting to understand the importance of asset allocation because, quite frankly, there are some big benefits. As I've already touched on, one big benefit is risk management. When you spread that money across different investments, it helps to reduce the overall risk. And if one investment does poorly, another might do well, so your total performance can be smoother. The second thing is what we call return enhancement. You see, and we understand this, different types of investments perform differently depending on economic cycles. So by having a good mixture, you can catch more opportunities and potentially earn more money while reducing your risk exposure. The third thing to look at is what we call long-term sustainability. The thing is, your strategy should match how long you plan to invest. So this ensures that your investments fit with your goals, whether they're short-term or long-term, income-driven, risk-driven, what have you. So I want to dig into two specific strategies that we hear a lot about, specifically when you have a handful of stocks doing really well. And the concept is a diverse portfolio versus a consolidated portfolio. A diverse portfolio is kind of like what we've been talking about. And this is like having a lot of different baskets, and you invest in stocks and bonds and real estate and more. And it's that way of really spreading out risk, and it aims for a balance between risk and reward. And there's some good pros to something like this. As we've talked about, there's less risk because of diversification. There's also potential for longer term higher return due to various opportunities, as well as smoother performance over time. But there's some cons or some drawbacks. One, it can be a bit more complex. There can be more cost due to a lot of investments, as well as if there's one or two stocks in the world that are doing really well, this is going to diversify out that upside, which is where we come to consolidated portfolios. And this is about putting all of your money into just a few or just one basket. And this can be a lot simpler, specifically if you really know one type of investment. So concept here is it's easy to manage, lower costs, and it's really good for those that know their stuff in one area. But your con on this is you are taking a lot of risk if that one basket doesn't do well. Think of it just choosing one stock and saying, I'm putting it all there. That's a consolidated basket. So now we've got to ask, what is the right strategy? And picking the right strategy really depends on your specific situation. So if you're not a fan of big risk and want steady performance, well, that's where a diverse portfolio is usually the way to go. It gives you more of a safety net when the market gets bumpy. But on the flip side, if you're an expert in one specific area and you can handle the ups and downs and you kind of crave that, then you might want to look at a consolidated portfolio because that might be more your thing. In our office, some folks go for a mix of both. They have a diverse core with a small part of their portfolio that's really more focused on specialized investments to maybe spice up their returns. Here's the thing. In the end, I need you to remember asset allocation is the key to investment returns. A good strategy is going to help you manage your risk and improve your returns over the long haul. And it also helps to make sure that your investments match your goals. So whether you go for something that's very diverse or something that's more consolidated, it all depends on how much risk you're willing and able to handle and how much you know and really what the goals you're aiming for. So don't forget, it's not just about what you invest in, it's about how you spread that money or you spread your investments that really counts. So for today, I want to thank you for tuning in to the Wealthologist Weekly, and we'll see you next time for more wealth wisdom.